All right. Well, as we have people coming in, we'll go ahead and get started since it's 3 o'clock, and we want to be mindful of everyone's time. So thank you all for joining us today. Delos Capital Advisors live market update. My name is Cody Lummus, and this is our Chief Investment Officer, Andrew Smith. First and foremost, we want to thank you for joining us. And if you weren't able to be here live, this is also being recorded. And so we want to thank you for taking the time to watch and hear our insights. Today, we're going to speak about a few different things. We're going to really dive into some investment strategy that Andrew will be speaking out. And then I will also go into more of our wealth advisory business and our wealth management approach and how we marry the two together. But before we really dive into that, I want to speak for just a minute about and thank everyone, our clients, our friends, and our partners. Yesterday was our 3-year anniversary at Delos Capital Advisors. Andrew and I couldn't be more thankful for the support that you all have given us over these last 3 years. It's been an amazing ride, and we are excited to see what the future holds. The second thing that Andrew and I thought about yesterday as we were putting the presentation, the final touches on the presentation. Today is the 2-year anniversary for us market nerds in a way of the market lows of COVID. First and foremost, I can't believe it's been 2 years. I'm thankful that it has been, it's behind us, and we are getting to move forward. So again, thank you all for being here. Thank you for our clients that are here, the many newcomers that we've had register and that we see have shown up. We're excited to present to you the information and the data that we have, and hopefully answer some questions at the end. If you have any questions as we go through this process or go through the information, please write it down or put it in the chat, and we will do our very best to answer all of them before our time's up this afternoon. So Andrew, I'll give it to you.
Awesome. Thank you, Cody, and welcome everyone. There should be a Q&A section or the ability to chat. So by all means, submit your questions if you have any. We have a lot of ground to cover, so I'm going to go ahead and share the screen and just start diving right into everything here. So give me 1 second. All right, everyone, I'm just going to get this in presentation mode real fast. And then Cody, you will just navigate for me if you don't mind. So what we're going to do today, starting on slide 6 that Cody's going to, is, as Cody mentioned, we have a few newcomers on the call, but also for some of our clients and prospects, go through what we have done as an investment philosophy or process, kind of where we've been, where we're going, and the prevailing investment strategy. These are definitely some interesting times, as you probably know. Some interesting statistics so far is the Russell 3000, which captures 95 to 98% of market capitalization of publicly U.S. companies. They're down 50% or more. 35% of those companies are down 50% or more. So when we talk about asset mania or bubbles popping, we really kind of have seen that already happen. There's a famous investor known as Kathy Wood who runs this ARK ETF, which is nothing but, hope for cash flows down the road, but currently innovative strategies, hopes and dreams, is down 50 to 60% in the last year. So a lot of capital has been erased from the market on top of an extremely aggressive Federal Reserve that we'll definitely get into, the sad Ukraine-Russian conflict, the COVID cases that are spiking in Asia, and then as well as the inflation situation that we've had to combat for the better part of now 2 years. So before I get into all of that, though, I would like to just touch base on really our investment process. We believe in our philosophy that financial markets are acutely sensitive to changes in economic conditions. And we really look at business cycles to understand what's the macroeconomic variable doing? What can we look at to see if economic growth is going higher, if monetary policy's tightening or loosening, what that's doing to inflation. And by monitoring the business cycle, we really can figure out what we want as a composition for our portfolios. And to be able to do that, we look at kind of 4 key indicators, which is central bank policy, inflation, interest rates, and liquidity, which is known as our pill model. And why we do that, this slide really depicts a great leading economic indicator. And this blue line is known as the ISM, which is Institute for Supply Management, PMI, Purchasing Manufacturing Index. So when I refer to PMIs down the road, this will be it. But the PMI tracks data back to the 40s. In fact, we have some PMI data that go even later back than this, but really it shows that high frequency business cycle, or AKA economic growth. And what you see is when that business cycle declines, when it hits below kind of this 50 line mark, there is an economic crisis somewhere. The latest one being a liquidity crisis and COVID crisis, the one before that, an energy crisis, and before that in 2011 almost, was, if we all remember, the pigs crisis, Portugal, Ireland, Greece, and Spain for their debt, and then obviously the great financial crisis. So doing that though, on the next page, why we want to harness business cycles is because they are leading economic data points. And if we overlay that leading economic data point to financial assets, we see tight correlations. So we do that by taking the top chart here, which is interest rates or yields. They overlay perfectly to the business cycle, to that PMI. The bottom chart is stock prices. Not on this chart, but we've done this with currencies. We've done this with commodities. And so we know, and also can tell, because the conference board has told us, leading economic indicators are not just PMIs, but they're asset prices. So we want to now get a sense of where is this PMI going? And by knowing where it's going, we know if bond yields are going up or down, or stock prices from a rate of return are going up and down. And that really drives a lot of our practice performance here at Delos Capital Advisors is, as you know intuitively, when PMIs come from a trough level, as Cody mentioned, today is kind of that low of COVID here, March 23rd, you get the best forward-looking annualized returns, which is known as that recovery period. Well, we've had that. And we've been in the reflationary period where things kind of have stagnated from a growth perspective, but still growing, just not growing at a faster pace. And now we're hitting a point, and the bulk of this conversation today is talking about, are we really getting into this accelerating leading economic indicator point, or are we going straight into what we call an aversion standpoint where, hey, markets are really starting to digest some bad economic news? And by having this, we now can guide our financial plans. We now can model out in those plans what assets we want to pull for distributions and what asset numbers or rates of return we want to project over the next few years for what client wealth needs to do for their retirement. So kind of giving this a little bit more context is understanding that by teasing out the business cycle, we look at factors being attributes of a company or of a sector, such as valuation, such as earnings growth, such as the quality of a balance sheet. We get a sense of how factors work through time. And to illustrate this, if we looked at the COVID lows on the very top chart here, beta itself, high beta represents really low balance sheet companies that really move much higher as the recovery unfolds, has moved up. But starting on April 2021, kind of really stagnated, denoted by that red dashed line. Now, this middle line chart shows that value, one would think value would do well, really doesn't step in until that beta is done, as kind of those value companies now really have a sense of where the economy is, which really took charge and has taken charge since April of 2021, and is now potentially at that stagnating level, which is now at the bottom chart, quality, good balance sheet, good earnings or low earnings variability of companies to now pick up. And so what we call this is just factors moving through the cycle, but it's not just factors, it's asset classes, it's commodities, it's different sectors, it's different industry groups within the sectors. And what we want to do is get a sense of where we're at using a nowcast of that business cycle so we can roll through the cycle with those proper exposures to help increase our probabilities of higher returns, or by increasing our probabilities of not capturing as much downside, which has been the name of the game so far this year. This has been a very volatile year. In fact, it's the second or third worst start to financial markets or stock prices since 1900. I mean, we've been through the thick of it, and that is normal, but by harnessing data, the less we can capture to the downside, the faster we can start recapturing to the upside when economic data turns positive. And so what we see today is we are now at the point, using that pill model I was telling you about earlier, policy, interest rates, inflation, liquidity, where economic conditions are set to slow. And this is quite normal. Business cycles are rhythmic. They are called cycles, cyclicality. And we have now seen, based on our indicators, and if we really hone in on kind of that interest rate and then inflation, this one being the interest rate, we're getting signs. We're getting multiple economic models that we have are nowcast that are telling us, hey guys, the economic conditions are set to slow from these levels. Because if we look at how market rates being a proxy for long-term interest rates, how they've moved over the last few years, or really 18 to 24 months, all of that tightening or higher rates now starts weighing on business conditions and using that PMI, that leading economic indicator, which is set to slow. So that guides us and says, okay, well, rates of return in the S&P 500 doesn't mean they're going to go negative on a year-over-year annualized basis, but they're not going to be as robust as they were. And we get that same indicator happening on the Fed rates, but most importantly, on the next slide, happening with inflation. Inflation has been a conversation that we have discussed wholeheartedly about. We were laughed off of, not laughed off, but definitely laughed at on a media segment in late 2020, early 2021, on how inflation was really going to be a big issue this cycle. And I think a lot of people have dismissed that because we haven't had that over the last 20 years. We've had a very low inflation environment or a disinflationary environment. But given what happened during COVID, a lot of dynamics have changed. And really, the takeaway here is we are at an economic slowdown. Nothing to worry about. It's just that what ushers in certain assets that have done very well for our clients now dictates a newer portfolio that do well during these slowing conditions. And so if we look at economic models, we call this an A/B test process. We can't just sit there and say, hey, what are the econometrics telling us? We need to now marry that to what market proxies are telling us. Well, if we look at home builders, to take a quick second, it's a very, very important chart. Home builders represent an economic multiplier to our GDP. Why? Lumber, costs for employees or putting people to work. When you move, you need movers. When you buy a house, inevitably, you're going to want to have new furniture in there. So the expansive money effect that happens is quite large. And what's been happening is with interest rates on mortgages up 40 to 50% since November, and home prices at all-time highs, we've already seen volume of new home sales in the lower cohorts of $300,000 or less, or $500,000, $300,000 of new home sales on a year-over-year basis decline precipitously. And that's being reflected now in a market proxy. So this is what we used in early 2018 to help guide us and say, hey, the economy is set to slow. We need to rotate the assets. And so when we tie all of that in together, we come up with our own econometric composite, really, which is the DCA Stress Index. And again, it's taking that leading economic indicator, that PMI, and saying, hey, oil has risen drastically, or aka gasoline prices, inflation, interest rate, the US dollar. This is all a headwind for US consumerism. And so therefore, hey guys, let's go into what would be that stability phase, or you want companies that are growthy. You want companies that have earnings that do well or grow, irrespective of what goes on in the business cycle, because they're not as cyclical. We're kind of call them hyper cyclical companies. And think of your Apples, think of your Amazons, your Microsofts. Those are good companies, but what ends up happening is that at this stage of the game, it might be a little different. And I always hate to say this time is different. There are certain dynamics that have unfolded that have us proceeding with caution. So here I kind of jumped the gun on slide 17. That stability phase shows that growth tech. It shows those treasuries, and it shows really kind of between the difference on that and then the aversion. And the aversion is really those defensive names and those assets that we want to be allocating towards. And all of those defensive assets compared to cyclicals ebb and flow with that business cycle. So going back to 2017, that yellow line is the equal weighted, so we don't have any large companies driving anything, cyclicals versus defensives. And so cyclicals underperform when the PMIs decelerate, and then cyclicals outperform defensives when the PMIs inflected in pretty much May of 2020. And those, again, cyclicals, financials, industrials, materials, and then defensives are staples, healthcare, real estate, and utilities. But our theme for this year is not a mid-cycle adjustment. That's been the mantra. Every wealth advisor that we talk with, every big bank, every hedge fund, every macro strategist who I associate with calls this a mid-cycle adjustment. Well, I'm pleading the case here in this chart that core CPI, inflation excluding food and energy, is so detached from federal funds rate by the widest deviation in history. So therefore, the Fed has been extremely stimulative. The old adage is that the Fed really kind of begins and ends business cycles, but they also really begin and end lofty asset prices, shown on that first chart with that little graph or that world. Well, what's happened is that home prices all-time highs. We've seen oil prices at all-time highs, yes, with geopolitical events, but even before that, after the oil collapse where it went negative, that intraday has risen drastically. We have seen interest rates move drastically higher. We have seen stock prices move drastically higher. We've seen companies without any operating profit get bidded up and worth more than companies that actually make sustainable operating profits. And this is a function of easy money, very common, very normal. But what's happening here is that the Fed has a dual mandate. And I know this chart's busy, so bear with me. But the Fed's dual mandate is supposed to be stable prices and maximum or close to maximum employment. Well, I argue that we already have more than stable prices. We have accelerating prices that is detrimental to consumerism, but we have been at full employment. And we have seen here that if we look at this blue line, this is the total job openings in the United States. And if you look at the total unemployed workers, the unemployed line, the red, is down to the COVID lows and is lower than it was in 2007 and is almost as low as it was in 2000. And what happens is when it gets that low, the Fed tightens. The Fed tightens because we have full employment. The Fed has never stayed this accommodative when we have so many job openings and yet such tight employment. Cody, what was the statistic? 4 million?
4.2 million.
4.2 million people retired or accelerated retirement after COVID. That is a drastic number. That alone has changed the evolution of the job market. On top of the massive fiscal stimulus checks that went out, it's the highest fiscal impulse in history of the United States. That's has disincentivized certain segments of income-based workers to go back to work. So the argument is the Fed has been at full employment. Inflation is much higher than the average of 2%. And if we go look at the old Taylor rule, which is John Taylor, a Stanford economist, it argues that today interest rates, monetary policy should be at 8%, 7.5 percentage points higher than where it is today. We're nowhere close to that. And we've been arguing that the Fed, by maintaining such a dovish standpoint, was really running out of room to raise rates as the economy was set to slow from natural occurrences. Now, this doesn't argue that the Fed's going to even get close to 8% because we've seen the Taylor rule shoot up higher before, but it definitely could go to 4. It could go to 4.5. That's still substantially higher than where we're at today. And the argument of why we're bringing this up is that everyone that we've spoken to really kind of talks about how inflation is totally transitory, or maybe not so transitory, but it will abate after geopolitical issues or abate after COVID issues or supply chain issues. But really, as I showed in the previous charts, it's all based off of wage inflation because there's so many jobs available versus how many people are still left unemployed. So unit labor costs are shooting through the roof. which has the highest correlation to core PCE. So let's just be devil's advocate here and say core inflation cools off because unit labor costs might calm down a little bit. Natural, you'll get a readjustment. But the argument that we make today is that going back to 2% is a foregone conclusion. The natural rate of rest for a core PCE or core inflation could be 4. It's currently clipping 6.4. So that really dictates, okay, guys, Fed, you have to raise rates. Jerome Powell, chairman of the Federal Reserve, came out the other day and totally spooked the market by basically saying 50 basis points is not taken off the table for future meetings. We've seen interest rates skyrocket 2.4% by 4 a.m. last night in overnight trading. That is a dramatic move because it was only at that point, about 2.1 or 1.93% Sunday evening. So we are seeing how the Fed, by changing their rhetoric, changing their statements, becoming more hawkish in every meeting, is driving that interest rate market. And we can't stress enough how important it is for them to get a handle on this. This chart right here is the chart of destruction of purchasing power for consumer dollars. It's at 40-year lows. This has a lot to do with gasoline prices. This has a lot to do with food prices. Not even just grocery stores, but food at restaurants. We've had a ton of restaurants close because of COVID. They have pricing power to now raise their prices. We had a client this morning who owns a restaurant. He has passed off his prices to consumers. That will manifest into the smaller low-income segments of the market first, which it's already done if we look at new home sales data and we look at sentiment indicators and how those income brackets are already feeling worse than they did in 2008 about future finances and about the ability to purchase a home. And just to illustrate this further, total job openings, the first slanted dot plot based on federal funds rate shows that the higher job openings in 2004 to 2006 dictated a higher federal funds rate. The next middle one is 2015 to 2018. The far right one that's completely horizontal is now. Highest job openings in history with the lowest federal funds rate. And so what we get from most macro strategists is, okay, guys, well, the Fed's raising rates. So that really kind of dictates once they've said, hey, we're going to start raising interest rates, long-term bond yields go down. And the reason why we stress long-term bond yields is because that's our discount factor into valuations. That's our ability to want to own long-term treasuries as a negative beta asset, one that's uncorrelated to stock prices during systematic risk events. And what we found is actually, if the economy does slow, interest rates don't necessarily go down. They can still go up. And these create those stagflationary environments. And that's where we believe that we have already entered into as leading economic indicators continue to slow. We do think disinflation will commence, but we're talking disinflation from extremely lofty levels. At present time, we have the lowest real rates, so 10-year treasury yields subtracted with headline inflation in history. Now, I'm not saying we're in the 70s environment, but I will tell you this based on research in my studies, that during the 60s, there was much more focus by the Federal Reserve to focus on full employment than it was price stability. We've done the same thing. The Fed talks more about full employment against different income brackets, against different race brackets or ethnicity brackets than they have talked about for the last 2 decades, just in the last 5 years, than price stability. Why? Because we've been in a disinflationary environment. But now we're at a point where real yields are so negative. There's nothing crazy by saying that the Fed could be aggressive in getting real yields back to at least the trend level of 0, not going back to where it was in the 80s when Volcker raised real yields to 10. We're not getting there. But real yields rising has a dramatic effect on asset allocation. And so what we have to do to make sure we preserve our wealth for our clients and hopefully try to get positive returns by either having positive forward performance or by having good relative outperformance from the downside that recaptures is by comprising a portfolio that's not going to be subjective or thrown around like a pinball in the pinball machine of the yield environment we're in, with assets that are low duration, high quality. So the ones that we've circled here are the ones that we really are avoiding that we would actually have in the portfolio. And we do have growth tech, we have high quality tech companies, but they're at our lowest weight in firm history based on the analysis we've done. We've maintained no allocation to treasuries. The reason why is if we look at 4 PE valuations for technology companies has an inverse correlation of almost 1. So meaning if real rates move higher, 4 PEs or valuations, price multiple compression of technology moves lower by the same degree. So if we know the Fed or feel confident the Fed is going to raise rates and real rates will move higher, we see a ton of volatility within that technology sector. The NASDAQ itself was in bear market territory just a few weeks ago. Too early to tell, but we might be just in a bear market bounce. But we were down 20%. The junk companies that are technology that don't make an operating profit, as I mentioned earlier, they're down 50%. And one thing that is astronomical is intermediate to long-term duration treasury and credit bonds have had the highest rolling drawdown in history based on the global aggregate bond index, wiping out as of this morning $2.6 trillion. So in our funding portfolios that our clients use for distribution phases, especially during volatile times for risk assets, we've maintained only inflation protected bonds, bonds that reset with inflation rates. We've maintained short duration treasuries because we knew rates were rising. So while the absolute return has been hard, we, from a composite standpoint, have only been down the same period, 0.58%, where the global ag is down 10.94. So by maintaining duration exposures from the equity side, then from the fixed income side, has allowed us to sidestep those risks. So what does that mean? That means that typically in this environment, while we would be in a stability phase, because PMIs are still up there, we're not declining drastically yet. We're going to go straight into the aversion phase like PMIs were moving drastically lower. And not because we think the economy is going to nosedive tomorrow or next month, but because the Federal Reserve is pricing in a much more hawkish, much more aggressive stance based on inflation than we've seen in a very long time. So with that being said, the quick analog I can provide for you is 2018. That's the most recent for us. So 2018, we saw PMIs, leading economic indicators, stagnate beginning at the end of Q1, beginning of Q2, stayed flat, but really started rolling over based on our econometric models, Q4 2018. That is that blue line. Underneath that blue line, you'll see the white line that has the shade blue underneath. That's the S&P 500. That yellow line, or orange line to you on the TV, is actually the federal funds rate. And they are hiking into an environment where PMIs are decelerating, causing stock prices to readjust. So the reason we bring that up is, what was the composition at that point? Utilities, absolute performance of 1.3%. Real estate outperformed the S&P 500 by 9.68%, absolute performance of negative 3.84. And you will see there, utilities, real estate, staples, those are defensive sectors. Low beta as a factor is a great defensive proxy to put in the portfolio. So what we're doing now with our clients is we are upgrading. We've been upgrading for the last few weeks. We are reducing out our cyclicality bets. The old adage there, mantra is, well, wait a second, financials do great when yields go up. That's true. But what happens is their earnings are completely cyclical based on the fact that they have to have loan growth. And if the economy starts stagnating because inflation is too high, we might not be as willing as consumers to go get those loans. So this stage of the cycle really is treated more of a defensive aspect. And that's my portion.
Thank you.
You're welcome.
I'm going to let you take a break and have a drink of water.
Thank you very much.
That was a lot of great information. Really appreciate it, Andrew. So as I mentioned earlier, if you do have questions about anything that Andrew spoke about, please put it in the chat. And once we're done with the wealth advisory portion, we will dive right into those questions. So I am going to speak briefly on our wealth management approach. When Andrew and I started the business planning for this firm, we always talked about truly bringing innovative wealth management and incorporating or marrying it with modern investment strategies. And how do we do that? And we spent a ton of time together discussing the different opportunities and different ways to do that. But it really came down to saying, understanding our clients and their cash flows, understanding to make sure that we insulate those dollars that they need to make sure that their lifestyle expenses are taken care of. And that funding bucket that Andrew mentioned earlier is sustainable so that we can then grow the remaining assets to help fund future lifestyle expenses, but also future goals, whether it be retirement or other goals that individuals or families may have. So as we look at this, we set out to say the traditional asset allocation, give you a really pretty pie chart with a lot of different diversified equities and bonds. Is that really the best way to go about providing and providing a stream of cash flow, but also giving you the most optimal portfolio for your goals and in the future? And so what we built was, let's look at this and say, okay, just because some go down, some go up, and over time you may gradually grow, why would we not look at it and say, if we are truly talking with our clients, investing with our clients and understanding their lifestyle, let's make sure that we have an understanding of all of their expenses. Insulate that for 12 to 18 to 24 months in a risk control bucket, if you will, that is there to beat inflation in most cases, but is there to be stable and is there to be turned on in true times of market stress, economic stress, or emergency. And again, the remainder of those dollars to be put into the risk asset bucket, which Andrew has spoken a lot about, which is our best thinking, which is what all of that data drives back to how we allocate the portfolio to help fund those future lifestyle expenses and goals. One thing that we look at and when we're defining and trying to build these portfolios is understanding what constitute as risk control, or what are those lifestyle expenses that we want to look at to make sure that we have funds set aside in the event that those are needed. We then look at what those lifestyle expenses may be. What are those retirement expenses, and how do we make sure that our DCAM or our risk asset portfolio is adequately funded and optimized to achieve those goals? And then lastly, for that segment of clients, then we start to look at legacy. How do we, not only for the family today, but how for our children, for our grandchildren, looking at different opportunities and different investment vehicles that may provide cash flow and growth over a much longer period of time. And as advisors, as a wealth management firm, we want to work with each of our families or institutional partners in making sure that we are optimally allocating and building an allocation that is going to help you achieve any of these goals or retirement that you want. This is an interesting chart that Andrew has shown, and I find that very interesting. I asked him to put it in. But so in times of stress, let's go back 2 years today, right, with COVID. Most broad markets, when you look at whether it's small caps, large caps, mid caps, international, so that pie chart, they all correlate to one, which means they all really go in the same direction. So what do we do? And how do we help our clients and insulate our clients' dollars? If you look at the bottom of this chart, you see where we look at the high quality. We look at municipal bonds. We look at inflation protected bonds, which are TIPS. And we look at cash and cash equivalents. Those high quality instruments, investment instruments that we are able to go find and put into the risk control bucket that we are able to turn on in times of stress, prove to outperform and really in most cases move in the opposite direction of the overall broad markets in these high times of economic stress or market turmoil, if you will. So some things that as a firm and as from a wealth management and planning standpoint, we would like you all to consider and really want to speak with our clients and partners about, or make sure you're reviewing your budget, understanding your cash needs analysis, utilizing your risk control during these volatile periods, especially for those that are close to retirement or in retirement. As Andrew talked about, we're seeing inflation that we haven't seen in 40 years. Make sure that you're adjusting current, but most importantly, future spending needs for an inflationary economy. I talked to a lot of people. I mean, we're seeing inflation today. When you're at 7 and 8%, and even if it goes to 4, we're still well above our average. So we want to make sure that we're preparing for that. We're running the different scenarios for that and utilizing math to help each of our clients make well-informed decisions, both from a budgetary standpoint, but also for future spending needs. From an estate planning standpoint, at the end of the day, we're in a year for midterms. I fully believe, and there's consensus on both sides, that taxes they'll either stay the same or they will move higher. And one of the things that we will see is potentially the estate tax, or in some cases, what's called the death tax. They could bring that back down. They won't do it this year, we don't believe, just given midterms. But if they do, you want to make sure that you are starting to plan for those instances, especially for those high net worth and ultra high net worth individuals. Make sure your will is in order. Your directives, your medical directives are up to date with the proper beneficiaries. Review your insurance policies with a focus on cost and product that will help you continue to achieve those future goals that you had originally put those insurance policies in place for. As interest rates rise, which Andrew talked about, and we know they're going to rise, insurance companies have the ability to offer more incentivized and better products out there. So for some, not all, but for some, depending on age, health, and a multitude of considerations, there may be opportunities to lower costs and get you the same, if not a better, it puts you in a better position. We can help through Delos risk management. We can help look at those policies, give you some of our opinion, but in no way are we here to sell you anything. We just want to make sure that as part of your overall strategy and plan, we are looking at everything that you have available. The last couple of things I would suggest, make sure you're taking advantage of all your tax advantage and tax deferral options. Maxing out your 401ks or your IRAs if it's within your budget. Health savings accounts. This is great for both those that are early in life with children, but also for those that are close to retirement. Those that are on the 10-yard line that are close to that retirement end zone. Doctor's bills, deductibles are not going to go away even in retirement. This is a great place to put money away tax deferred that you are able to take with you once you leave your employment that can then offset or help pay for health and Medicare costs down the road. And lastly, 529 college planning. This is also great for young families. And then also as a gifting strategy for grandparents and other family members that are looking to give to children within their family. This is something that is parent owned, or this is owned by an adult or guardian with the child as a beneficiary. So there's still some control. It has also become more flexible. It can be used for primary school or secondary education now, not just secondary college, things of that nature. And the last thing that we spend a lot of time on, tax loss harvesting. This is a great strategy in years where we do see volatility, where we are making active changes to the portfolio because of what we're seeing in the data, looking for opportunities to make slight adjustments to, in some cases, take losses to help offset some of the future gains that you may have. And that is something that we focus a lot on. We love to speak with CPAs. If your CPA, or we want to be as part of your team to find the best strategies possible to help mitigate any taxes or tax issues that you might have in the future. With that in mind, we are going to get off the share screen here. We had some questions sent in. Let's see what is going on there.
So someone sent in a question, but it came out weird. Could you show your aversion portfolio again? It came out in a straight vertical line. Sorry, hold on. How do you view new energy and
That's actually that's one of the questions. So let's see if we don't answer it. We've got about 7 questions here. So let's see if we don't answer it, and then we'll figure it out from there.
yeah, okay.
Okay, so I'm going to read these just as they were typed out, and Andrew will dive right in. So through the lens of global macro, how do you anticipate rising global political turmoil to affect the corporate M&A and IPO markets this year and into next year?
That's a great question. So we have to kind of break that into 2 pieces. So what we have seen actually over the last few weeks is record issuance of fixed income from investment banks. The reason is rates are moving higher. Companies want to take advantage of putting debt out there without having to pay higher interest costs. There we go. So that will be part of more corporate issuance that may help M&A. Here's my big concern, though, with the M&A piece. These higher discount rates change the valuation of every company, right? That's how we run valuations of our assets in the United States or the world. So by higher discount rates, that does change the multiples, and it does highly depend on the business. So businesses that are going to be more technology-based, ones that don't have operating profit, ones that aren't seen as substitute goods, but really kind of that core input good, acyclical need every day, those will maintain. But we actually will see as we get further into this reduction in economic cycle, as we get higher interest rates, you'll see a very dramatic pullback in M&A activity, or you will see deals that now come to the table that might be 20 to 30% less in valuation than what was originally stated. So it's a very, very slippery slope. The companies that, again, will benefit, there's going to be a higher bid up for those names that are staple like businesses, but ones that do have very cyclical earnings projections, ones that are highly discounted based, aka so many out future cash flows that have to be net present value today, that changes the whole game. So you will see a dramatic change in M&A. There was a second piece of that question.
Yeah. So, I mean, we're looking, obviously, flight to quality. What types of companies? I mean, are we liquidity? Are we looking at quality companies? I think you answered a lot of that there.
Yes. So we definitely want to stay with quality companies, but we have to be mindful of what quality means. So there's a great ETF out there. It's called Qual, Qual. The problem with Qual as a factor, if you look at that from just an index level basis, is that's filled with technology companies. Again, Apple, Amazon, Microsoft, Google, those are good companies. They make a ton of money, but they are thrown in to all of these ETFs that represent the highest market capitalization between those 5 to 6 companies that we've ever had. So when you get those ETFs that are riddled with all the other companies that don't have an operating profit, they're correlating just as much, not maybe to the same degree actually, but they have the same correlation. So when those prices go down, they're going to go down with them, aka when those companies go down as a sector because of the rising interest rate story. So quality typically now has been synonymous with tech, where really you want that duration exposure out of that portfolio. And those are companies that are very sensitive to higher interest rates, which again is technology companies. And knowing because of the proliferation of ETFs, how many institutional owners own all those ETFs, those are just, it's kind of like the baby thrown out with the bathwater. Is the best way to say that.
Okay, thank you. Another question from a client. Several friends are always bragging about their gold purchases. Could you please comment on gold, its pluses or minuses?
Yeah. So gold, for some reason, has always been deemed as this inflation hedge. Partly so. It's really a fear hedge. So gold does well when inflation's rising and economic conditions are collapsing because you lose faith in the monetary system. So what ends up happening is we do want to own gold during those periods like we did in 2018, and you definitely wanted it in 2020 when there is just a lack of faith in fiat currencies. Because of the debt loads that we have globally, there's always a case to be made for having a precious metal in the portfolio. And we always argue, you could take delivery of some gold or go buy coins and use them. But if we get to that standpoint where fiat currency or US dollars are no longer taken, we're going to need more things than just gold, because the economy is going to collapse dramatically, and we'll be hoarding bread and water before gold coins. So as a portfolio composition, though, I do believe it does make sense, but it does correlate to interest rates. And what we need for gold to really work in the portfolio composition is where the economy is really slowing very dramatically. We're not there just yet, but we've started to build out an allocation to our gold thesis.
Would you say, and I know we talk about this a lot, would you put that same kind of mindset around looking at silver, copper, other commodities out there? Or
silver is a great trade because it is cheaper, obviously, than gold. Copper, not as much.
Okay.
Copper, because of its input good to the industrial function of our products, will see a deceleration. We've already seen a deceleration a little bit in copper, but mostly you've seen it in lumber. You're seeing other industrial commodities begin to start slowing down from a rate of change perspective because it's pricing in that slower growth.
okay. From your thoughts, how are we, ideally the Fed, going to manage inflation? And is this a replay of the 70s situation?
That's the great question. So the Federal Reserve really, I'm just going to be brutally honest, has mucked this up. He's mucked it up because we should have been aggressive in raising rates last year. And now we're at a point where inflation has gotten so out of control that their only option is to raise monetary policy. And it will create or begin that process of a dramatically slowing business cycle. We saw the destruction and purchasing power of our dollar. 40-year lows is nothing to joke about, especially if you're in your early midst of retirement. So we do believe that the Fed is going to be forced to raise rates still faster than what the market is expecting. They will also probably taper and reduce assets at a quicker rate. Let's be very clear. The Fed is still buying some mortgages. We haven't fully seen the Fed slow that down. When the Fed reduces or goes net zero on all their mortgages, then you will know we're in a full tapering aspect. We're not there. The Fed's only control is to reduce headline inflation, which it will, but the geopolitical conflict, what's going on overseas, doesn't make it any better. And by waiting, you literally are waiting for an Eastern conflict to finish, or the destruction of your consumerism, which is already happening with 70% of GDP coming from that consumerism function. I argue they're going to raise rates, not hold off because of the geopolitical conflict.
I know we have to look at the size of those economies too, right? I mean,
Right.
It's
Right.
less than the size of Texas
That's
in
right.
some cases. So let's segue with that into the question that we have here. How do you view energy? And I think that goes not only for what's going on in Europe, but also when you think about Texas and most of us being here. How do you view energy and defense stocks in context of continuing Ukraine and Russia conflict, but also the massive increase we've seen in oil and gas over the last 8 to 12 months?
Yes, so that's a really unique question, and it's just going to be hard to postulate. So obviously what's happened with the price of oil really has driven a lot of fear because we've seen gasoline prices go up. Well, and again, not trying to be political here, but the administrations that we do have are not very keen on giving our energy sector subsidies to go turn on more oil fields. We have seen the Baker Hughes rig count move up, but it is nowhere near at 2015 levels. These energy companies are already at full capacity because we're producing more barrels of oil than we were back in 2015.
Right.
So we know that capacity
I
is
think we
there.
should say that again. I mean, I think that's a very important point. We are producing more barrels of oil today than we were.
With much less in rig count.
The efficiencies are there.
And so the efficiencies are there,
Right.
but we don't have an administration that will allow us to open it up more. So that creates, in my mind, a secular trend for energy. I do believe, hopefully with the right conversations, that we should be opening up. I mean, Elon Musk himself came out and said, we need to open it up. We now are having conversations with Venezuela and Saudi Arabia to get our oil. Our dependence on other nations that are not friends with us, it needs to be rectified. It does need to be fixed. So my belief is that I do believe that we will see more energy companies come online. We've already seen some small cap energy companies start expanding and going out, taking on debt to go open up more oil fields. So I am thinking there is a secular case there. Now, here's the caveat. Because of what's going on in China with COVID cases, and because we are experiencing a global economic slowdown, I would not be surprised to see the price of oil drop from here. Now, again, I'm not saying it's going back to 40. I don't believe that could happen. Models probably predict it could go to 80, could go a little lower, but
Where it went before the conflict.
Before the conflict, right? The reason being because of the lack of producers, but more so the demand will slow because inflation is so high. I took a trip, it was $1,000 plane ticket the other week. Little Rock from Dallas right now is $700 a ticket. I mean, that's not normal, right? So as demand gets squeezed, those prices will adjust. So we do take a pretty secular view on energy itself, but we are holding back, saying maybe energy commodities, the price points they're at, could create a potential short chance for you.
So we're kind of probably on the top end. We're probably going to trade in some ranges and potentially move back.
That's
if something were to cease over in Europe, kind of thing.
But I don't believe the energy sector as a whole is done with its with its tailwind. I believe that there's more to that story, and therefore we do remain constructive from a secular view. You did want to see the aversion portfolio, so let me flip the mouse real quick, and I'll get to there. Then we'll get to the last couple of questions before we conclude. So for the aversion portfolio, let me get there real fast for you. This is the aversion portfolio. Now, keep in mind, when we show these are just assets that have the highest empirical risk-adjusted returns. Does not mean that these assets go down. It just means that these have a better chance during the current phase of actually producing, at least with a higher probability, a positive return, or again, less drawdown than what these other assets would do, given their beta and their cyclicality of earnings. So this is why we tilt the portfolio to sit there and say, okay, maybe this is where we want to be from an aggregate perspective, but it does not mean that energy as a sector will underperform because of its secular trend. It's just based on our process and back tests that these are the names and this is what we want to own. Okay, that was the Q&A.
Yeah, over there. There we go. So to follow up question on the commodities and the dollar, how do you view risk on assets at this time? And your favorite subject, Bitcoin, given the dollar debate, of course.
So, commodities itself, I've kind of already answered the, industrial energy commodity complex. Again, we're seeing lumber prices collapse. Food prices are still moving higher. A lot of that's based off, Ukraine being a very large wheat producer. But as a whole, netting out geopolitical conflicts, as the economy slows, there is a higher demand for US dollars. There is a flight to quality, as Cody has mentioned. So you see assets flee emerging markets, European markets in favor of US-based assets or treasuries. So there is a ton of demand still for our treasury market because now we have higher yields than the rest of the world. But to buy those bonds, you have to convert your currency into US dollars. So we have seen US dollars move higher, which the correlation right now, because of the geopolitical conflict, is broken with some of these energy commodities. But given the slowdown that we are predicting, we are not very bullish on the commodity complex. We only believe precious metals serve a purpose in the portfolio, and that still will take time because the economy is not slowing tomorrow, but we are on the path. Call it yellow lights. We've been in Matthew McConaughey's green lights. We're now in yellow lights, and they're flashing strong ambers, and we will hit that red light scenario, and that's when gold starts picking up. Bitcoin should really provided a ton of clues for most people. Bitcoin did not serve as an inflation hedge. Bitcoin did not serve as a financial asset hedge. Bitcoin collapsed from 68,000 down to yesterday it was 42, 43,000. I don't track it all that closely. So dollar debasement has always been a concern, but the viability of Bitcoin being an alternative currency hasn't really shown to be fruitful, especially given this year and the geopolitical conflict that's happened. Bitcoin is truly pricing. If we overlay Bitcoin with high beta assets, again, assets that do well when the economy recovers, so aka junk balance sheets, that's the highest correlation. It doesn't correlate to a treasury bond, doesn't correlate to the dollar. So to me, there's always been this thought process of dollar debasement. Now, I will tell you this as a monetary theorist or as someone that has studied the Fed for a very long time, the Federal Reserve also is not going to lose control after it's worked so hard on maintaining that reserve status. So that's why they themselves have been working out their own currency or digital currency process. As far as the dollar debasement goes, yes, dollar debasement has happened given the debt loads out there, but that's been happening for a very long time. We can't confuse ourselves and say that this is a newer phenomenon, but at the end of the day, are you wanting a precious metal like gold coins or a digital currency that might or might not be accepted at a vendor that might or might not have the computing power to translate that digital coin, to make that digital coin? So we're not constructive on it. Is it a phenomenal trading asset? Absolutely, because of its volatility ranges. But we believe now Bitcoin is pricing in that slower growth because it's a high beta asset. It has been slowing. If you bought in last year, you haven't made any money, right? So if you were to trade that, now's not the time. You need more dollar debasement actually for that to work, and dollar debasement in the sense of massive liquidity injections, not when the monetary policy is tightening.
Perfect. All right. With time running out, one last question. Biggest risk you see for 2022?
The biggest risk I see in 2022 is
Just broad markets, private equity. Let's go anywhere. Where do you see, from an economic standpoint, the biggest risk as we move to 2022?
I think that a lot of people have underappreciated the fact that, well, rates have been so low and they compare it always to the 70s. This mere fact of rate of change, right? We have to always look at financial assets, not from an absolute level, but how fast you're running up a mountain. And the steeper we get to that summit, the more of the incline we have, the harder our heart is working and the more likelihood of a heart attack. We have seen mortgage rates skyrocket. We've seen real rates collapse. We've seen regular nominal rates skyrocket. We know with inflation where it's at, that if the Fed moves much, much more aggressive than even I'm anticipating, we will see a very strong repricing of ultra risk assets. The biggest thing to me, there is a bubble that most people are talking about, is in private equity. I still firmly believe private equity, because there's so many dollars chasing so few deals based on this illiquidity premium, which hasn't actually beat public markets in the last 5 years from an average standpoint. You're going to get repriced. And what happens is you might get your money back, but they're going to hoard that dollar because they're going to extend their J curve out another 5 years. And so that really has a massive destruction on liquidity. And when you need that liquidity to fund your lifestyle. So to me, is our base case is for risk, it could be worse from the inflation story because the Fed will be raising rates much, much more faster than anyone is expecting.
Which could trickle into multiple asset classes.
M&A,
Yep.
and private equity, home. If we look at household net wealth from a balance sheet perspective globally, there's two things that comprise that for the majority: your home price and your stock, your 401k retirement accounts. Okay, well, we already know home prices will reflect because they're your primary residence, not a cash flow producing property. That will get repriced with higher rates. Well, that's already happened, right? So you've got that. Now you have lower stock prices because those get repriced with higher rates. Duh, that's how it's an asset, that's how it works. But then that changes your overall net worth, and that changes your ability to go get a loan at the bank. So there is seismic effects to this. That's why for us, we want to reduce the beta, the exposures, have low volatility in the portfolio, so we can at least control that aspect to weather through this storm, which is quite common.
Okay, great. Well, it's 4 o'clock. There is one last one. Any thoughts on oil? Let's do this one real quick. Being traded in the yen versus the dollar.
Yeah, I saw that article come out. So, China has actually really been working on their currency to become a more stable currency. That could be a very big issue down the road. I'm going to be honest, I have not put enough thought into that just yet because that will also be very challenging to do for them. But it will be a problem if it does get traded in yen because we continue to then lose that reserve status currency. Reserve status currency is, yes, our economic conditions and our growth, but it's also because a lot of assets, not just oil, but dollar denominated debt in emerging markets are all, again, based on the dollar. So not something we want to have happen, not something that might happen relatively soon, and something I need to probably learn a little bit more about, but it's probably, that's a few years down the road if it does happen situation.
Okay. All right. Well, thank you all very much for joining us this afternoon. Again, thank you for 3 wonderful years. We're looking forward to the future ahead. On behalf of Andrew and I, have a great afternoon and a great weekend. Take care.
Thank you, everyone. Goodbye.